Good afternoon, everyone, and thank you for joining us for today's webinar on demystifying revenue recognition for tech companies and their investors. My name is Maddie Robbins, and I'm our technical producer with Cherry Bekaert. We have a great presentation planned for you today, and we're offering up 1 hour of CPE for this session. Now, before we get started, I wanted to go through some of our housekeeping. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. We will also be sharing a short survey at the end of the session. It will pop up on your browser shortly after the session concludes. CPE certificates will also be issued via email within 10 days. If after 10 days you have not received one, please email cbhlearning@cbh.com. A recorded version of this webinar will also be available. In about a week, it'll be sent via email and also posted to our website. Now, if you do have any questions during this webinar, please locate the control panel at the bottom of your screen. You can type a question into that chat box, and we will answer whatever we have time for during the session. Now, we will be monitoring the chat and collecting all of those questions so we can follow up with you via email after the session. And with that, I am happy to turn it over to Stacy LaMontagne and Michael Valerio with Cherry Bekaert, who will be presenting on demystifying revenue recognition for their tech companies and their investors. Please, Michael, take it away.
Thanks, Maddie. Hi, everyone, and welcome again. I'm Michael Valerio, and I lead our technology practice for the firm. With me, I have my 2 esteemed colleagues. First of all, Stacy LaMontagne. Stacy is an audit partner in our DC practice, and she focuses primarily working with venture capital companies and private equity, primarily in the technology industry. In addition, we have Chase Wright going to be joining us here shortly, and he leads our advisory, accounting and advisory services for the firm. So he's a great technical resource as you're working through these revenue recognition memos. You may have noticed we plan to have Liz Bowski be from our deal advisory team, be our moderator, but she's unfortunately under the weather, and you'll have to deal with me as the moderator for now, so bear with me. So first of all, we're going to kick it off today, and the standard for 606 has been around for a few years now, and many of the public companies adopted it back in 2018. Private companies adopted it, had an extra year with COVID to adopt it for 2020. And so really don't want to go through the whole standard, but as a reminder, these are the 5 steps of revenue recognition. And we're not going to really deal a whole lot with step 1 right now, but really focus on some of the key other areas and maybe some of the interesting elements as it affects tech companies. So I'm going to start focusing on performance obligation number 2, which is identifying the performance obligations, and then I'll have some of my colleagues talk through some of the other steps. So a few things I wanted to highlight, as it relates to performance obligations. So the first thing is, identifying them, and is each obligation distinct or not? And so that's usually the biggest challenge of determining do we have a separate performance obligation or do we not? So I have a couple of different examples I wanted to go through. One relates to hardware and software considerations. If you go back, we can talk through the rest. So sorry about that. Then we're going to also talk about a separate example on implementation services. So with hardware and software considerations, one of the items just to highlight is a question: is there 2-way interdependence? And what that means is there really separate value related to the one or the other independently from the software? If they're both needing each other for essential functionality, then yes, you would need to combine those. But if they have separate value, you may be able to separate those out. Professional services, implementation, and other related services have under the new standard, there's been a lot more allocation of a new PO related to that, but there are times where those items need to be combined with one performance obligation. And then one thing you should look at is if there's any material rights, and we'll talk about that a little later as well with Chase. But one thing, just look in your contracts. Are you promising anything for future good or service, or are you have something in the renewal process at a discount that it makes it look like you've given them a right to buy later, and that can affect also allocation. So going into the examples real quick here is the first one. Was a health IT company. So quickly just say a health IT company sells both hardware devices and software to provide analytics from data retrieved from that software. The hardware provides independent value from the software for audible alerts. The software retrieves data and provides analytics on the usage of the hardware, but it must be connected to the hardware to provide the analytics. The customer is going to be charged separately for both the hardware and software subscription up front. So the question here is, how many performance obligations do we have? And the answer here is 2 in this scenario, because the hardware has independent value. And so even though the software needs the hardware does not need the software and has independent value to the customer because it's providing those audible alerts. So in a lot of cases, we're seeing hardware being combined with software, but in some cases, we're seeing hardware separately identified. The next example, just going through professional services, just going through that quickly, is a software company generally sells off-the-shelf software and is available for use upon delivery of the license. The company has implementation services for data migration, customer onboarding and training, and configuration services. So again, the question here is, how many performance obligations do we have? And the answer is, it depends, right? So it depends on what these implementation services are. Typically, data migration, customer onboarding, training, and configuration services are all separate POs. However, as you get into configuration and services and heavy implementation that are customized to your customer, you may have instances where you're going to need to have at least access to the source code to do some of those configuration services. And in that case, you may have a situation where you need to combine those. Or if the customer onboarding is more truly a setup fee and there's really nothing to do. But a lot of times we do see customer onboarding and training just in access for professional services and providing hours related to doing that. So with that, I'm going to pass it to Stacy to talk more about step 3.
Yeah, thanks, Michael. So some of the challenges that I have faced with my clients, in particular around the software as a service world, is around the transaction price in step 3, and really focusing on, do we have variable consideration versus fixed consideration? We're going to go through a couple of examples around that as well. But the key to keep in mind with transaction price in step 3 is that the guidance says that you have to estimate your transaction price at the beginning of the contract. So if you find that you're in a situation that does have variable consideration, then there's the possibility that you're going to have to do that estimation process up front. Now, we're going to talk a little bit about distinct service periods here shortly that kind of help maybe avoid some of that with some practical expedience, but keep that in mind. The other area that I've started to see a lot more discussions around is consideration payable to a customer. We'll also go through an example there, but this is a situation of, is it going to be reduced revenue, or is it going to be recorded as an actual expense of the company? But to just dive right into an example for variable consideration, in this case, we have company A sells a 1-year subscription to company B. The subscription allows company B to access the software from the cloud, and the pricing is based off of the number of users each month. The company B will be charged $500 per user each month in arrears. Do we have fixed or variable consideration? And so I sometimes get a mixed bag of answers here, which is, well, it's fixed because the per user charge is fixed. You're right, that is fixed. However, because the number of users is variable, that creates variable consideration. Now, there's ways to potentially not have to estimate this at the beginning of the contract if you have a distinct service period. And I'll touch on that in just a moment. But let's take this one step further. Same example, but let's say you have tiered pricing. And tiered pricing happens a lot of the time, primarily because we're trying to give customers volume discounts, right? So in this case, if you have up to 5 users, it'll be $500 a user, 6 to 10, it's $450 per user, et cetera. Again, how does this change your revenue recognition? Well, if you're having to look at the entire year of a contract because it only resets every year, then you're going to have to estimate your number of users at the beginning of the contract period. However, what I'm finding more often than not is that most companies that either use a tiered structure or have a usage-based model like this, the usage resets every month. And because it resets every month, your month becomes a distinct service period. And so you avoid that whole idea of having to estimate how many users you might have or how many transactions you might process for the entire year. And therefore, revenue recognition gets a lot simpler at that point. And that's a nice practical expedient to get through things. But, keep in mind, let's say it only resets quarterly or it resets every year. If those quarterly periods and annual periods do not coincide with your reporting period. So let's say, for example, company has a contract that runs for 1 year and it runs from, February 1st to January 31st. Well, then because you're going over the service period, over your reporting period, you're going to have to estimate how many users are going to be utilized for that whole year and then divide by 12 to recognize revenue. You'll be able to, true up your estimates at your end of the reporting period. But again, my recommendation, if you're going to go this route with usage-based pricing, try and have it reset on a monthly or quarterly basis to try and save yourself some, accounting nightmares down the road here. The other area that I mentioned was consideration payable to a customer. Again, if the key here is, are you buying something from your customer that is distinct from what you're selling them? If it is, easy answer. It's just like buying product or services from any vendor. You're recognized it as an expense. But if it's not really distinct from the service that you're offering, then it's really just considered part of your transaction price right from the beginning. And if that's the case, then it becomes a reduction of revenue as opposed to an expense of the company. In the example we have here, we have company X sells a 1-year SaaS subscription to company Z for $12,000. Company X will pay Z 25 cents for every transaction processed through the SaaS. So if we're looking at just the first sentence, this sounds pretty easy. Revenue recognition is going to be, 12,000 divided by 12. This is great. But if we're incentivizing the company Z to process transactions through the software and potentially paying them to do so, and it's not distinct, then that's going to become a reduction of your transaction price. So take this a step further. Let's assume that company X and Z determined that they believe $4,000 worth of transactions will be processed. Your transaction price for step 3 just became $12,000 minus 4 for a total of $8,000. $8,000 would then be recognized ratably over the 12-month period in this particular case. Now you may be wondering, why on earth would a company potentially do something like this? Why would they pay a customer to process more transactions through the software? In this particular case, my client also has a whole nother revenue stream where they're earning additional revenue for the number of transactions processed through the software. So they have a reason to incentivize their customers to process as much as humanly possible through the software. So with that, we're going to go to our first polling question, and it should pop up on your screen here very shortly. Thank you. And the first question is, what are you currently using to track contracts? And Just one quick housekeeping item to keep in mind, guys. They're going to be 4 polling questions. You do need to answer 3 of those in order to get CPE credit. So please take a minute here to answer our question.
Yeah, quick shout out to SaaS Optics. They're a client of ours. I see a few of you folks have used them. We have a lot of I think they have an announcement tomorrow on some branding, so keep a lookout for that. And then what I typically see as expected here, we have a lot of manual Excel, but the other ones we have some answers there as well. NetSuite and Intact being 2 of the ones that we see the most from there, but then I also see other. The QuickBooks one is one we see in that manual Excel. Other software you could have voted for that as well.
Now, I know I can do a quick shout out to Dixie and our client accounting services group, who is starting to utilize Intact to bring on a lot of clients as well. So I'm definitely seeing some more clients utilizing those folks.
All right, there's a few more voters. All right, polling is closed. I'm going to share those results for you. So a lot again on manual Excel. You see some SaaS Optics as well. So.
All right, Michael, I will move on in the slides for you.
Sure. So we talked about 2 and 3, and I'm going to pass it to Chase. So what do you think about 4 and 5? What are you seeing that are going from there?
Yeah, no, thanks, Michael, and happy to be with everyone today. Yeah, so in accounting advisory, we do quite a few consultations around revenue recognition, even after the initial adoption. We find step 2 to be particularly challenging, and we have moved through step 2 in this presentation, and now we're to step 4. This one can get a little tricky if it's applicable to you. It relates to how do you allocate value, and determining the applicability really is a consideration. Is is your contractual price that you're presenting to a client a good proxy for fair value? Really, contractual price does not always equal fair value. You may have some profit inherent in one piece or the other that's covering for another element, and frankly, some of your deliverables may not have a readily available fair value. So there is a little bit of work to do here, and I can touch on some of the things that we see. I tell you, though, overall, this is quite an improvement from the old days of having to establish vendor-specific objective evidence, or as we all knew and love, VSOE, and the challenges that could create, especially when trying to price PCS type arrangements. So, in general, it's a welcome change. But determining fair value, we have been very successful in coming up with a rational way to allocate a fair value using marketplace data points, using company history, or if nothing else is other information is available, really creating that fair value by using a cost plus margin estimate. And some of the consultations that we've had lately as it relates to step 4 relate to, hey, can I have multiple fair values for a single unit of accounting or a single performance obligation? And the answer is sure, in some occasions. And you might think about, the best way to think about this is, think about the, outside of technology and the wholesale retail model where you're providing the same product, you're packaging it differently, you're marketing it differently. And so there's a different fair value for a wholesale versus retail. The same is true for technology. We see some technology clients who have essentially much more synergies of scale, perhaps with a larger customer or a larger relationship. And so really there's 2 different, if you will, standalone values. Another question is, hey, do I really need to have a point estimate, or can I have a range to equal fair value? And what we tell our clients is that it's frequently smart to start with a range of fair value. But in the end, you'll see in an example that we'll show momentarily, that it's a mathematical exercise that you go through if you reallocate value among the performance obligations. We sometimes find that the cumulative fair value of our performance obligations exceeds the selling price. So you have to go through a pro rata allocation. And when you do that, a point estimate is needed, but a range is a good way to get there. So we're not opposed to starting with the range, but coming up with the best number within that range if needed. The standard allows a lot of judgment. So we wouldn't, you shouldn't be afraid of having to come up with that one value. Residual approach is even allowed under the standard. That was a no-no under the old revenue standard, right? So the FASB has come out and said, hey, if you have an arrangement where you have 3 performance obligations and you know the standalone value of the 2 and the other just isn't really as determinable, perhaps you have no evidence and perhaps it's your secret sauce, there's no competitor selling a similar product, you can use a residual price just by taking essentially the fair value of the other 2 and thinking through, margins and the like, and determining if the remainder of your sales price can be allocated to that performance obligation. That is allowable, and we've seen it practiced. Other areas where we frequently, Michael touched on material rights. That's a complex area in general, and it becomes really complex under step 4 because not only do you have to assign a fair value, you also have to assign a probability in determining that fair value. So there are really 2 estimates involved in allocating transaction price to fair value. So on the next slide, we have a interesting allocation example. And here we have a customer that has a perpetual and a term license offering to their customers. And they're having to go about an exercise of considering how to allocate value to each of these. And if you'll look at the first example, here TechCo is selling to UserCo a perpetual license for $1 million. However, if you look at the standalone value of the technology versus the post-customer support or the technical support, you'll see that the standalone value exceeds the transaction price. So there is an exercise, as you can see, to ratably allocate value to those performance obligations. Now take a look at the term license. So generally, this same product, the customer is offering under a 1-year term or a 3-year term. And in general, you'll see that under a term license, which may be a lower price point because you're not giving the customer the software, you're allowing them to use it for a period, that price may be $400,000. Well, the value to the customer, the allocation percentage will be the same. And so you can see how that $400,000 would be allocated among the performance obligations using the same percentages. Now, if you were to offer the same term license for 3 years, you're obviously going to be in a situation where you're going to incur significant cost to provide the PCS or the technical support, and for a long period of time. So in that case, much larger portion of the pie or portion of your transaction price will get allocated to the performance obligation related to the PCS. So this is the exercise that you go through when you're trying to determine how to allocate fair value to your performance obligations. Well, I tell you, one really interesting concept that we find in technology is really differentiating between a perpetual license, a term license. And I know, Stacy, you see this a lot in your clients. And Michael, you probably do as well.
I do. And, I often get the question of, what's the difference between a term-based license and a SaaS subscription? And then the real key, the driver to all this is the ownership. So in a term-based license, even though it's term-based, it's still a product that is generally on-prem. It's behind your firewalls. It's on your computer, which is very different from a SaaS model, which is cloud-based and not on-prem. So, think about it from this standpoint when it comes to revenue recognition. For term-based, you take the revenue up front because, once a company has delivered a term-based license, there's no obligation to continue to provide, anything. The license has been delivered, you have it, it's on your computer, you can use it. Whereas with a cloud-based product like a SaaS platform, you have an obligation to continue to provide a stand-ready, platform. But you have to make sure that that it can stay live, that this doesn't have any downtime and things like that. So because you have that stand-ready obligation, it's recognized over time as opposed to the upfront recognition. The other things that we're commonly seeing as a difference between term-based and subscription is that maintenance is typically charged separately in a term-based license structure, whereas with SaaS, it's just built into your general SaaS platform, and that's generally what I'm seeing. That's kind of how I use it best to describe it to my clients.
Yeah, and I would just say I caveat everything there was that's the typical. So there's always little nuance sometimes that
Yes.
point in time and over time, but that's generally the term generally there. Chase, thanks for all the step 4. So move us into step 5.
Yeah, step 5, you're almost there, right? You can almost recognize your revenue. All you got to do is jump through 5 hoops in this accounting world. But now step 5 really doesn't necessarily have the complexity that perhaps the other steps have, but it is important to understand these concepts, and we can talk a bit about where our clients are continuing to consult with us. Step 5 relates to the period over which you can recognize your revenue. And, the standard starts by saying there are 2 ways to recognize revenue: at a point in time or over time. And those concepts seem simple. And in fact, in many industries, they are. Let's think about your traditional manufacturing client that has FOB shipping point. It's really easy for them to understand when they're recognizing revenue. It's at a point in time when they meet those FOB shipping point terms. For a technology company, perhaps not as easy. Maybe if you're providing a perpetual license, it can be fairly simple to get to a point in time. But in many cases, we're not, especially as you move toward a SaaS model, which many of our clients, want to do. There's judgment when you're using over time as to how quickly to recognize the revenue. And we'll talk about the methods that the FASB allows. Generally speaking, the FASB and really the ASEPA technology subcommittee really used considerations around intellectual property in determining, okay, how quickly can you recognize revenue? And there are 2 different types of intellectual property that are described in the standard. The first is functional intellectual property, or functional IP. And that is essentially intellectual property that has just that, standalone value. Think about completed media content. Whenever Turner Movies buys the media content, that seller can recognize that revenue immediately, unless they're on some type of model where there's over time, they can use it for a term, if you will, or a drug formula that's sold. Perhaps that's another good example of a point in time. Pull that into the technology world. Think about your perpetual license again. That's where you get your point in time. Symbolic IP is different. There is no true standalone functionality. It needs to work with something much like similar your SaaS model. The software that the customer is accessing needs to work with the hosting solution that our clients or the vendors have put in place for the customer to use. So those are how the concepts work. If you get to over time, the 2 ways to recognize revenue are using an input method or an output method. And an input, you may think about a construction or a professional service type model where you pledge to provide a project for a certain cost and your inputs. And so you use the input method. On the output side, we don't see this quite as much really in any industry, but an output method would be something really based on milestones. Now, when we have large, perhaps government clients where we have software companies providing some solution to the government, there may very well be milestones and such that an output method would be more appropriate than an input method. And that would be strictly aligned to these milestones. So where do we see consultations quite a bit still? The first is around really implementation or installation services. I know Michael talked about these as it relates to the step 2 evaluation. This can really be tricky because, again, if it's not complex, if a third party could do the work, you can recognize that revenue much faster than if there's a product that needs significant customization and perhaps customized interfaces. And, you know, really without this level of service, the software product just will not work as intended. That's not likely to get a separate accounting. And so, you know, that really continues to be a topic that we consult on, because essentially if you end up in bucket 2, well, over time could very well be applied to both. You know, if your installation, let's say, is very quick, let's say it's 2 days, then your overtime period is 2 days, which is almost point in time. If it's something longer, it could very well be, you know, a month or so. If it's customization, it's very likely to be deferred over the term period or over some period of time that includes an estimate of renewals. So that is something that we see a lot of consultation on. Technical support, really, there is a lot of discussion in the FASB standard around a stand ready obligation, and that is a on-call type obligation that we've made in a contract with the customer. Whereas if they need service, we're there. Perhaps it's 24/7, perhaps it's 8 to 5, perhaps it's some other period. But that is called a stand ready obligation. And it fits real neatly around PCS frequently because that's what we're doing. And many of our clients, that level of service doesn't vary over time. It's the same level of service, and often that garners over time ratable recognition is what we see. Absence of other evidence, that's likely where you'll end up around technical support. And then we see some questions around upgrades. Generally, upgrades that are just functionality related, generally we consider that more aligned as an element of your technical support. So really not a separate performance obligation. So we've had quite a few questions around, and if the upgrades are significant enough, perhaps they could affect the timing of your technical support recognition. But if the upgrades really add new functionality, or if your customer has promised features to their customers as a result of your upgrade, perhaps it is a separate obligation and gets recognized at a point in time. So those are areas. I will say that the FASB put out a couple of practical expedients that were quite helpful in technology. One in particular is an as invoiced expedient, which allows you to, rather than going through the bean counting of essentially measuring small differences in a monthly billing versus revenue you earn that month, the FASB says, okay, if they're similar, you can apply this expedient and just recognize revenue as invoiced. And we find that to be very frequently adopted for a PCS type arrangement where your billing really coincides with the level of service you're providing over time. Quick example that highlights the period of time recognizing revenue. You'll see here, this touches on the installation matter, and we have to go through this with many clients. You know, okay, I've got a little bit of a different installation for this customer. I need to figure out if this accounting is separate or if it's distinct or if it's not distinct, or the terms that we used. And you'll see for this client, we're just analyzing what the impact would be. You know, we've gone through steps 1 and 2 and 3 and 4. We've determined what the performance obligations are. We have determined that the contract value is $1 million, or that step 3, the the amount we're receiving is $1 million. And we've gone through step 4 and determined an allocated value of that $1 million. And so now we're just determining how quickly or how slowly, depending on your accounting, you will recognize that revenue. If that installation is distinct so that it can stand on its own and be accounted for on its own, if it takes a year, you're going to recognize that in that same year. So you'll see here, year 1 for distinct categorization gets really much quicker revenue recognition. Whereas if it's not distinct, it will be deferred over the term period, which in this case is 3 years. So you'll see that there's recognition over a slower pattern, a couple $100,000 in the first year, catching up in the latter years. So that is a good example of recognition patterns and the like, and how that's how to apply step 5. And that actually takes us to the next polling question. And that is, do you have the right internal resources to analyze new and complex contracts? We see technology evolving fast, and in general, we see that a lot of companies are scaling. Perhaps they have an accounting team. Perhaps their accounting team may just be focused on day-to-day, billing those customers, paying your payables, paying your payroll for sure, and booking journal entries. And if there's a new contract, we're often called to provide some ad hoc services to really analyze those contracts. It looks like most of our answers here are, well, a third and 2/3 and a third. Yes, our people are starting to understand this, and yes, they can understand the concepts. And then others who really probably are having some of the challenges that others are having with finding accounting talent. Let me share this. I think we're sharing the results with you now. So one thing I'll also say that we're seeing is we have helped some companies with the round 2 of training on a new contract, so that eventually, and helping come up with the results, so that eventually it will be something that clients can handle internally as part of their month-end close process. So that's a little commentary on step 5. Michael, you want to take it from there?
Sure. Thanks. I'm going to quickly cover principal versus agent, and then we'll get to the exciting topic of commissions, and we'll turn it back to Chase, let him take a breather here. So under principal versus agent, just really highlighting here, what are the indicators of each? Historically, there were certain things like, credit risk that, is not a factor under 606. We used to hang our hat a lot on that. But just quickly, the entity is primarily responsible for fulfilling the service or providing the good. And if you had hardware, for example, that's a strong indicator for principal. Inventory risk. So if you take that inventory before it's been transferred or after transferred to the customer, you've taken on that risk, like a right of return, for example, on that. And do you have discretion on pricing? That's critical. So even if you're selling to resellers who then mark up, but I have clients that, here's what the minimum software price is. You can sell it and take a little margin yourself. You're still the principal in that transaction for the price that you give there. So, but on the flip side, if you were the agent reselling, yes, you might have a limited pricing discretion, but really you're the agent selling, you're not delivering that software, et cetera, or you don't perform that service. Fixed fees or commissions are not necessarily, it's a red flag, but that doesn't necessarily mean you are exclusively the agent. But fixed fee is a big indicator, and that will be scrutinized by your auditors as you get through that. So with that, I'm going to pass it back to Chase. We're talking about commissions. We know that's a a hot topic as it relates to tech companies and RevRec.
Yeah, thanks, Michael. And yeah, you're exactly right. This is a hot topic. I mean, you guys are all, trying to get your products out to the marketplace, and the best way to do that is through a sales force that is focused on introducing your concepts and the like. And so most of you, especially in earlier stage and even tech growth companies, and really even a larger tech company, really throughout, I would say, is you incentivize those sales with sales commissions. And so this is a punitive area of the standard as it relates to the industry, because it nails you kind of right in the forehead and requires you to consider capitalizing these costs and amortizing them over essentially the term that the client will use your product. And so this is something that all of our clients have to consider. Now, with that said, what costs have to be capitalized? And the FASB try to keep it simple, but you just can't keep this simple because it's so important to our clients to have competitive commission structures. The FASB said that whenever both parties agree to a sale that triggers a liability from the company, then you have to consider whether or not that cost should be capitalized. So, if salesman A makes a sale and will be paid for it, that triggers liability to the company, and you have to consider if that's capitalizable. Thankfully, the FASB allowed for a practical expedient, but that is a fairly narrow practical expedient. We see it capture about, 50% of the cases that we see out there, maybe even less. And that is, if you have software and you perhaps you have PCS in addition to the software, other support, and if you expect just to have 1 year essentially relationship with the client, then you can expense those costs. Otherwise, you have to capitalize them. So if renewals are expected, they're capitalizable. So that is the practical expedient. Now, we also get a lot of questions around, okay, great, I have cumulative thresholds that if my salesmen do not reach a certain threshold, there will be no payments. And is that applicable? Is that within the FASB standard? The answer is yes. Those costs have to be considered for capitalization. Apply the same concept. If there are enough sales that are incurred where there is essentially liability owed by the company, then you do need to consider capitalizing those costs. Now, what that has done is create a little bit of diversity in practice among our public tech companies that have interim reporting requirements, especially when their commission structure is on an annual basis. Do you need to estimate volume to determine if some amount will be accrued because of a cumulative threshold? Likewise, we see that commissions paid to anyone, a sales rep, supervisors, third parties, no exception, everything's in scope. We get these questions a lot. So an upsell where you pay a commission, yep, that's in scope if it's going to benefit the company for more than a year. And renewals become really tricky here because you're really having to estimate the life of the relationship with the customer. It's just as important an estimate as your maybe your allowance for doubtful accounts. You're going to have to estimate your renewal period. And if you estimate that to be too long, then you're going to have a change in estimate in the next period. You also have to consider other items such as, if you have a salesperson who leaves before commissions paid, perhaps your competitor down the street hired them, you may need to impair their commission asset or the prepaid commission asset. So, all the concepts come into play that are just unique. So we get a lot of questions around this and really have to work with a lot of our clients around some complex calculations. In fact, here's an example on the next slide. This is a public company that had some essentially hardware and software that was needed to treat a patient. So it's a clinical care environment using technology. actually this product is used to treat depression. And as a, because of the healthcare reimbursement, each patient had have their own individual software code. And so individually, the hardware did not do much without this code, and vice versa. The code was useless without the hardware. So the step 2 conclusion was, hey, this is one performance obligation. Well, that's all great, but what we found was that essentially this company, and again, it's a public company, was paying commission on essentially the hardware and the software. And so the company had to go through a really complex exercise to determine what commissions needed to be capitalized. And this one was particularly punitive because those machines by the physicians had utility for 8 years. And so some portion of those commissions had to be amortized over an 8-year period. So that's an example of essentially where you essentially have to go through a very long amortization period. So that is commissions. And we want to hear from you guys. Again, commissions are very important in technology to proliferate your product out there. You know, we see a lot of focus around this. Stacy, I know you were sharing some interesting things with us earlier. You may talk about some of your clients and what you're seeing.
Yeah, and this kind of goes in line with the poll question we have out there right now about how often do you all change your commission structures? And what I'm seeing is that it's happening pretty frequently and regularly throughout a year. And you know, when I have conversations with the CFOs and CEOs, they're like, okay, yeah, we understand we have to go back through and relook at 606 and how you know, the commissions policy under 340 would be, you know, how it might change things. And, you know, commonly I get the comment back of like, well, we can't let the tail wag the dog. And I wholeheartedly agree with that. You know, business is business and we have to do what's best for the companies. But just knowing that every time, you know, revenue contracts change or commission policies change, we do have to reevaluate what those changes, how that could impact the company from an accounting perspective.
Yeah, so I guess we got to share the results. And yeah, no, historically, yeah, annually is, you know, normally what it's been. And like Stacy was saying, we're starting to see more and more companies in this environment to start, you know, tweaking with it throughout the year. Highly recommend, you know, do what you can on that. Just you know, have a few thoughts. Want to have the group overall talk through maybe some unique terms in the contract as we go through, and I'll kick it off and you know, start saying, you know, termination clauses. Look out for those. There's some termination for convenience clauses there, and we, you know, Chase mentioned, you know, point in time, over time. Well, if you have a termination for convenience, you may have to do a ratable recognition on that rather than a point in time. So, you know, various terms in your contracts. We mentioned material rights. Stacy, Chase, what else are you guys seeing in contracts to keep an eye out for?
Yeah, I can jump in there. I mean, the tier pricing, which I talked about before, is definitely a big deal with SaaS-based companies. The other one that's coming up occasionally is around financing components around step 3. If you have like a 3-year contract and you are allowed companies or require companies to pay up front for the full 3 years as opposed to just 1 year. Or on the flip side, if it's a 3-year contract and you don't require payment until later in the 3rd year or 2nd year, there could be financing components associated with that the company would need to take into consideration. Chase, what are the types of things you're seeing?
Yeah, sure. Yeah, I mean, think about the current economic times and the roller coaster world. And we've seen some things pop out of that, if you will. First of all, you have to be very competitive in your commission structure. So we see that leading to changes around commissions and different accounting, you know, but you may also have to make some concessions with customers who are not faring well through all of this with supply chain or with COVID. And so you may be providing discounted pricing, different pricing. That's likely a modification that needs to be accounted for separately. So those are some things that really kind of come to mind that are unique and current.
Thanks, guys. So, we're coming to the end of our time here. I do want to, look for some final thoughts as we look ahead to the group, and hopefully we've answered some of the questions you have. But what are some final thoughts? Anybody want to share that?
Yeah, I'd say one of my final thoughts is, coming down the pipe is a new ASU 2021-08 related to business combinations. And you may say, well, why am I bringing up business combinations when we're talking about revenue recognition? And it's because in this standard, companies are going to be able to record deferred revenue at the ASC 606 value, as opposed to having to record it at fair value in a business combination. Anybody that's been in the SaaS world or technology software world for a period of time knows that in a business combination, deferred revenue takes a significant haircut during the fair value analysis. And as a result, you get revenue that gets trapped and that nobody ever gets to take. So I will say that gets me excited. It's effective for 2024 for private companies, 2023 for public companies, but early adoption is permitted.
Guys, take advantage of that new standard, early adopt for the PEG groups out, for the portfolio companies. Dealing with deferred revenue in a business combination is painful. You could have some, unrecognized revenue during that transition. It is very friendly, and we highly encourage you to consider adopting that new standard early.
Yeah, one thing I'll say on that is I'm sure, in-house, just reporting to the board or investor group that you might have, just not having to back that back out. It was, many of my clients are frustrated with, communicating the whys behind it. And so I think, again, early adopt, that's our recommendation for you there. As we're coming to a close here, it looks like maybe we got a couple more seconds, and then, just to make sure everybody gets credit here, and then we can share results. But it looks like a pretty even split here between debt and equity, compensation plans, lease standards coming up. Chase, our team is real busy working through that.
Yeah, no, in general, technology companies do not have as many leases, but you got to deal with this, right? So we've created some really interesting and really what I would say easy and inexpensive ways to help you navigate that standards without burdening your staff much. There's some good technology products. You guys will appreciate this if anyone will, that can allow you to deal with this efficiently and effectively. And we're happy to help you. We've helped hundreds of companies with the standard.
We're a licensed lease query implementation, and then we also partner with Lease Crunch on that as well. So
Lease query, Lease Crunch, we know them all.
Yeah. So thanks again for joining. We left our contact information here. You can, hopefully we answered some of your questions that you've been dealing with. But if you have more, please reach out, to us, and we're happy to get back to you. We're also as we close this, we're gonna have a short survey. Just want to get feedback. So we want to provide really strong, relevant content to you, and make sure we're tailoring it specifically for our tech companies. So take care and have a great day.